Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is Amit Kalyani, Deputy Managing Director at Bharat Forge. Amit, thank you very much for joining us on BQ. To begin with, Amit, a good set of numbers from a standalone perspective, but I think your overseas subsidiaries are dragging the consolidated numbers lower. Uh, can you give us a perspective of how the overseas subsidiaries are working?
Yeah, so as we mentioned towards the end of last year, in the first half of last year, that we will see an improvement quarter on quarter in our overseas subsidiaries. This quarter, the EBITDA loss came down from 63 crores to about 49 crores. Next quarter, we will see our European subsidiaries in the black. And I think in the quarter after next, we will see all our subsidiaries in the black. So we are on a path to recovery, and some of the steps that were more long term are being taken, and we should see the results of that in Europe next quarter and the US quarter after next.
Aluminum business was a drag. What is the kind of outlook that you see for FY24 for aluminum, considering that I think you have already contracted for FY24 largely?
So the demand is not an issue. We have plenty of demand. The issue is to get pricing for our cost corrections, pricing action and pricing correction for the cost increases that we have had, and some ramp up issues in our US plant, which are now under control. And we will start ramping up the production from Q1 of this year. And you'll see sequentially quarter on quarter improvement. And in Europe, we will see obviously this quarter itself we will see black numbers. And I think between these actions, by the end of the year, we should have a healthy performance from outside India.
How is the order book looking at the end of FY23?
Order book is very strong. Actually, I think this is the strongest order book we have ever had. And the heartening figure is that this order book is now providing an inflection for the company. In the past, we only had two reportable business units, or two basically segments that we looked at. One was industrial and one was automotive. Now we are seeing even the defense vertical starting to kick in, and we have an order book of over 2,000 crores from defense, and that will result in significant growth in the defense business this year and also carry over into next year. And this includes probably the largest ever export orders won by an Indian company for defense.
So, what is the total export of this? What is the total export for the order book in with respect to defense alone?
Our defense exports are about more than 200 million.
Okay. How is the defense portfolio doing? Because you have seen gradual ramp up of entire defense from and you are now providing products instead of earlier only assemblies and others. How do you see this platform rising from here, and from the point of view of ramp up, especially from exports as well as from a domestic order book point of view?
Yeah, so we had said that this year, which is 23-24, will be an inflection year for us in defense, and this will come through three ways. One is that ramping up of our, or let's say, start of production and supply of serial production of our artillery products, both to exports and to domestic markets. Ramp up of our vehicles business, and thirdly is our components and consumables supply, where we have got a healthy order book. So we expect that this year is the inflection year where defense becomes a meaningful contributor to our overall revenue. I would say that if you look at 2018, our defense revenue was just over 100 crores. 23, it was about 300 crores. This year we expect that this should grow, more than double to triple of that, more than 3 times of that. And it will contribute to more than 10% of our standalone revenue. So it's a significant growth, and year after year we will see a significant ramp up and growth in our defense business.
From an automotive point of view, if you look at the business, it's done pretty well. How do you see the demand in that segment going to FY24?
So demand right now is very strong. In fact, a lot of countries have reported numbers where demand and sales are high. In fact, production is lagging sales in most geographies because of supply chain issues on the semiconductor side. But in spite of this, production is at a fairly strong number. Waiting periods are long, and both for passenger cars and commercial vehicle, the outlook still remains fairly strong.
What about e-mobility? Because that's a platform that you have invested and you're growing that business.
Yeah, so e-mobility will be this will be a year of actual beginning of production and ramp up, but meaningful growth in this will happen next year. But I think we're now at a place where you will start seeing triple digit revenues coming from this vertical even on a quarterly basis towards the second half of the year.
Give us a sense of how the North American Class 8 business is working. We've seen some bit of sluggishness in that market. Are you seeing that in your demand and order book?
No, so our demand and order book is still very strong. The waiting periods for vehicles still remains long, and in fact, production is also running at high numbers and expected to continue because there is still an infrastructure push in the US. There is still a lot of gas grids which are being built and so on and so forth. So I think the truck market is strong both in US and Europe and expected to remain strong at least till 24-25.
How about the industrials? Because there you're looking at some new businesses, which includes renewable construction and mining. What is the kind of traction that you're getting in these businesses?
Yeah, so we've actually got very good traction in these areas. Just to put that into perspective, as you're aware, we acquired a business in Coimbatore called JS Auto last year. When we acquired the business, it had about 400 crores of revenue. And we've actually acquired new orders, already orders received of more than 400 crores. And we expect that this business, what we had originally planned to double in 3 years, I think we will be able to double it in 2 years and grow even faster than what we had anticipated. We see this business becoming a major growth driver and value creator for Bharat Forge in the next this year, next year, and years going forward.
And for the other segments that you're looking at,
so on the on the renewable energy front, we see a lot of growth. On the construction and mining equipment, there's a lot of growth. In fact, we have new orders that we have won. We have won about almost 500 crores of orders in the industrial space. We have a lot of new orders on the pass car space, which will start ramping up in the second half of this year. Our passenger car revenue has grown almost 53% by export-led growth of about 71% this year to about 1,300 crores. Aerospace has grown. Aerospace has more than doubled this year, and we expect it to have high double-digit growth next year also. So more than 30-40% growth next year also. And as I had always said, that aerospace will become a major growth driver of high technology, niche, high value products that is coming close to fruition. We have made a lot of progress on ESG as well. Our ESG rating has improved across the board. We have become a member of the First Movers Alliance, and we are completely aligned with the SDG goals of the UN. And in fact, we will have all our plants heading towards being completely carbon and water neutral by 25 in India and by 30 outside India.
What is the kind of investments that you're undertaking currently? Because all these segments are growing at a faster rate. Are you looking at capex over the next 1 or 2 years? What is the kind of capex that you're looking at?
So currently, the only major capex that we're doing, and it's not very large, it's about 120 crores for defense, where we're building 3 new plants about an hour away from Pune. That's about 500,000 square feet of factory space, basically for the entire use of entire manufacturing of all our defense verticals at one location.
So that consolidation is you're undertaking that consolidation of defense production into
one.
Because
there are a lot of statutory and regulatory safety requirements and security requirements for defense manufacturing. and to do it at multiple locations doesn't make sense. So we're doing this at one location close to Pune, and that will be where the assembly and integration happens. Component supply will obviously happen from Bharat Forge or any of our other companies, and the integration and testing will happen at that plant.
Give me a sense of how your debt has moved, because it has gone up over the last 1 year to 1 from 0.85. Though you have enough cash in your books, what is the reason for that movement?
So on a gross basis, on a consolidated basis, we have over 3,000 crores of cash. Our long-term debt is about 1,750 crores on a standalone basis. We have our working capital debt has gone up because exports have gone up, and that is basically financed through bill discounting, which is non-recourse financing, but it still remains on the books. So that actually reflects the increase in exports. Our exports were about 550 million this year, so that's more than almost 4,400 odd crores. So the increase in working capital is because of growth.
So you crossed the 500 million mark in the exports front. Can you give me a sense of where the growth is coming from exports, especially defense exports? Are you looking at the African continent for defense exports? Which are the areas that you're looking at? And from other segments, where is the growth coming from as far as exports are concerned?
See, geographically, our biggest export markets are the US, followed by Europe, and then it's rest of the world. That's true for all our sectors, whether it is a passenger car, whether it's commercial vehicles, whether it is industrials or construction and mining. For defense, our current export orders are largely from Europe and from non-conflict countries, and that is where the big orders are from. In terms of growth, the growth over the last 5 years has really come from passenger vehicles, from defense, well, little bit, and mainly from industrial and aerospace.
Amit, in the defense space, where you're looking at your revenues to triple in this financial year, given the kind of book you have, we have seen that because of this ongoing Russia-Ukraine conflict, a lot of capacities in the developed markets are catering to that, and that's creating a huge demand from non-conflicted countries, especially in the African continent, which is there. Are you getting enough demand coming in from those continents?
I'll tell you, our engagement with the continent has just started, because that's being, let's say, supported by the Indian government and the MEA. But we have got a very strong engagement in Europe, and that is where our first orders have come from, multiple large orders. And the next orders obviously will come from other locations.
Okay. Finally, Amit, on a standalone...
So what I'm trying to say is that even without Africa being a contributor, we already have a fairly healthy order book, and we will continue to grow this.
Okay.
We're adding a lot of new products to our order pipeline.
Okay. Finally, your EBITDA margin on a standalone basis have gone up by 50 bips, if I'm not wrong. Do you see further potential in there, given that raw material prices have cooled a bit? You see further potential to expand your EBITDA margin on a standalone basis?
I think as product mix and utilization improves in the second half of the year, we hope that there will be an improvement in the EBITDA margins as well.
Amit, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you very much.
Thank you.